What's going on, everybody? Welcome to a capital hungry 3-part webinar on a weekly recap and refresher, higher time frame review, as well as intraday analysis and trade ideas. The reason why we're doing it in this format is purely for efficiency purposes. So we're just going to be starting the first portion of this webinar doing the weekly recap and refresher. Honestly, there is not too much to recap in terms of key events from last week, besides Bank of Japan rate decision, as other key economic events were relatively short-lived in impact and did not lead to any shift in structure on gold, US dollar pairs, US equities, and so forth. We can see from a macro standpoint, obviously we have a lot of important figures in focus this week with the Fed rate decision, ECB, PMI figures, and of course the US jobs reports towards the end of the week there. But for the time being, due to mixed economic data, as well as a lack of volume and volatility or any new events to price in to bring any changes to sentiment on US dollar pairs, gold, and so forth, the Fed pivot prayer narrative has been holding the most weight. We can see this validated as gold is still holding above the 1970s, dollar still holding below 102, VIX still ranging to new lows, and the optimism and greed still being maintained in the stock markets around the world, with the primary example of looking at US 30 Dow Jones, right? Now, even though that sentiment is still holding the most weight, it can 100% be flipped on its head with some of the events we have focused this week. We can see dollar domination come back into the scene and potential shift in risk flows if we do get more optimistic US data, hawkish pressure from the Feds, and of course, if we get any new fear, uncertainty, and doubt events on a global perspective, not just directly impacting the US economy or US markets. But pretty much in terms of a weekly recap and refresher on gold, dollar pairs, dollar individually, and US equities, we're still primarily in secondary phases of market structure, either in large consolidations or just having some short-term pullbacks. But dollar weakness and Fed pivot prayer has still been holding the most weight in terms of fundamental sentiment. We've still primarily been more on the bullish side above the 1970s on gold until we have fundamental reasons to adapt otherwise and start to see that larger bearish corrective leg take place, which we will be talking about during our higher time frame review portion of this webinar. We can see, even though we had this aggressive consolidation towards the end of the week, dollar weakness extended with, of course, GU trading higher. Euro USD primarily just stayed in ranges throughout the week, but still holding bullish market structure as dollar holds below 102. Equities just started the last week out with some ranging, but did the expected pullback into liquidity zone, closing back at these intraday highs at 34K. So the Fed pivot prayer narrative is still holding the most weight, which is, of course, fueled by declining inflation figures we've seen with the US CPI and PPI data, as well as more of the US economic data being in the recessionary scare range. Understanding market psychology, we also have to take into consideration that it's a lot easier for the equity markets, like global stocks, to be bullish rather than bearish, understanding the economic implications of very bearish stock markets to, of course, global markets, economies, jobs, and everything down the line, right? So US 30 is still holding that greed and optimism, just did that pullback we expected to retest that liquidity zone of interest, roughly at 33.4 to 33.5 key level. And we're still seeing, even though we had that indecision, dollar still holding below 102 and VIX printing some new intraday lows. Other than that, the really key event from last week in terms of impact on Japanese yen was the Bank of Japan rate decision. Bank of Japan did what we expected of the priced-in sentiment of keeping their monetary policy on the dovish stance and keeping financial conditions very loose, even with some comments that they can be ready to do some more monetary easing if needed. After a expected liquidity grab, as it was very well known that they would remain more on the dovish side, we ended up sweeping that price sensitivity area at 75 and having that expected meltdown, potentially starting to dig into the 72.873 handle. This, of course, led to GJPYs extending a lot further, which was our pre-planned analysis and main bias we were looking to play anyways. But besides that larger inflow of buyer volume on GJ, primarily induced due to a weaker yen from a dovish Bank of Japan monetary policy, other economic events such as US data remained mixed, and other asset classes such as gold just continued to range, dollar pairs were ranging, and equity markets just had that pullback before closing back at those highs. Nothing else really to recap from last week besides those events we just went over. Now, as we're approaching the end of the business month, that is April, it's always good to zoom out and get a bird's eye view of the markets and understand your overall macro positioning. So let's do that and just go through the pairs one by one, starting with gold, then looking at US dollar, obviously looking at that correlation to dollar pairs after, then looking at US equities and GJ to finish it off. Now, gold on the higher time frame, you can see is still respecting higher time frame bullish structure and bullish sequence of events. But as manual retail traders, we must remain objective, and we cannot be delusional to seeing the same rejection at these very large historical highs around the 2050s and into the 2060s. Remember, it was very important fundamental catalysts that brought us to these price points, and the upside we maintained above the 2010s, sitting at those highs at 2040s and 2050s, was relatively short-lived for each of these fundamental catalysts. Whether it was, of course, the initial fear of COVID, the lockdowns, and money pumping phase here, whether it was Russia invading Ukraine and the military escalations and the fear, uncertainty, and doubt that brought, or whether it was the stacking bad US economic data coupled with global banking sector fallouts from the SVB collapse in the US to Credit Suisse issue within the European banking sector. Yes, we're getting this bullish monthly close potentially above these candle bodies, but it's almost just sitting in line with those levels, right? Now, at the same time, gold is potentially rejecting those historical highs, still starting to close below the 2000s there. And on the intraday, we've been noticing a very aggressive liquidity zone around the 2010 key level, right? At the same time, we've seen dollar struggling to break that key historical level around 101.5 to that 102 price point. Now, to start out this new month, we do have a lot of important fundamental catalysts that can induce one-sided volatility and increase market volume. We have PMI figures from the US and other global regions. We have central bank rate decisions from the Federal Reserve to the ECB. We have important economic data such as US jobs figures to close off the week, right? What we would need to see from a fundamental perspective for dollar to hold 102 and start to see dollar domination come back into the scene and potentially see a bearish corrective leg down on gold, which can easily come to retest bullish market structure points as well as these previous significant monthly candle body highs going into the 1910s and 1920s, we will need to see optimistic US data coupled with hawkish Fed pressure and dollar holding above that 102 price point. That would lead, these fundamental catalysts, as well as market sentiment catalysts, would lead to this corrective leg on gold, where I'm not expecting bearish downside moves all the way into the 1800s or 1700s. That's something we would, of course, deduct if we start to see this corrective leg take place, potential bearish pullback induced by these fundamental catalysts, but I would at least expect us to be revisiting the 1920s and 1910s. It might not seem like much here when you're just drawing out this monthly candle that can take place, but from current price positioning, or give or take having some pullbacks, especially with all the volatility we can expect to come into this week in terms of the economic events to start out the new month, right? Even dropping from current price points at the 1990s down to the 1920s is 500 to 700 plus pips, right? That's a monstrous potential corrective leg and pullback to see take place on gold, where as a manual retail trader who's scalping or day trading or even swing trading, you obviously don't want to be buying gold as you're entering a potential corrective leg or pullback that can be 500 pips in size, right? For example, even though gold is bullish during this entire time, it's very easy to say in hindsight, oh man, gold buys are easy. Just keep jumping in gold buys. But it's not that easy as a manual retail trader when it comes to execution if you don't understand market sentiment, fundamentals, and price wave changes. For example, from a psychological perspective, majority of retail traders are trading every day, whether that's scalping, day trading, and so forth. A monthly candle, of course, lasting, giving you 22 whatever business days to trade, that's a lot of time for you to potentially fuck up your account if you're on the wrong side of the markets. Look at a simple example here. Where gold had this corrective downside bearish move that lasted for an entire month before continuing bullish to these 2000s. If you're just simply saying, well, gold's easy, just be bullish and buy. If you are clearly from a retail trading perspective buying during this month, as you're going down from the 1950s all the way into the 1840s, which is 1,000 pips, you're obviously going to be on the wrong side of the market from a scalping and day trading perspective and be destroying your account. We are not investors. We're not investing other people's money or managing funds. We are individual retail traders that scalp and day trade the markets. These fluctuations in price on the intraday level, weekly level, and monthly level are very important for us in our potential account growth or failure, depending if we stay adaptive to the conditions, right? So it might not seem like much, but gold potentially even starting to have this corrective leg just to create a pullback from this historical price point. If we have these fundamental catalysts, that's 700 down, that's 700 pips of downside just from current price points. Never mind if we still get some potential pullbacks or liquidity grabs that can occur before having that pullback phase, right? Now, for the time being, the major catalyst, especially to start out this new month, whether we make or break gold around the 2000s and start to see this corrective leg take place, which would be translated like this on the daily time frame, right? Will need to be those confirms stated. One, we really don't want to be breaking back above that CPI price point and liquidity zone into the 2010s and 2020s there. Two, from a technical perspective, you want to be trading below the 1970s. And three, you want those fundamental catalysts that would be bringing back dollar domination. And you can expect us to be having this corrective leg to the downside where we might not be looking for any key buys again until we revisit the 1910s and 1920s. It's very similar to this situation. Taking advantage of gold buys as you had declining inflation figures that were being fed to us at that time, started to have these banking sector fallouts and so forth is perfectly fine. But just sticking to that bias can really burn you as a retail trader if you can't understand the fundamental and technical confirms that lead to these large corrections or changes in price here, right? You obviously, from here into February, going all the way into mid-March here, you obviously didn't want to be buying gold until you had the shift in structure, buyers coming back into play, retesting a key liquidity zone. And then potentially assessing better buy areas, right? Now, the same time, gold is potentially starting to show us a very similar sequence of events here where we can start to have a corrective bearish leg take place. You can see when we're looking at the higher time frame, dollar has been very, very stubborn and failing to break that key historical price point, sitting at roughly 101 to 101.2. Now remember, as we had this dollar domination phase, what we've had to start out 2023 is a pretty fair correction, which is roughly a 50% correction of this overall bullish higher time frame rally. Yes, dollar can obviously dig deeper, understanding its historical movement, and essentially as we've been in this channel, of course we could dig deeper and have legs down to 96 before starting to see buyers enter the market. But that's going to be completely data dependent, and we have to take it level by level. This is a very important price point we have been monitoring, roughly from 101 to 102 from a historical standpoint. And even during the dollar domination phase, as we had buy side orders accumulate from this area. Even as we've had some declining CPI and producer price index data, as well as increasing recessionary scare data with US economic activity declining as well, we've still maintained price above that key price sensitivity area. If we get more optimistic US data this week, Feds bring the hawkish pressure in terms of their monetary policy stance, giving us the Kobe Bryant saying the job is not finished yet on inflation, and we still need to keep monetary policy conditions tight and financial conditions tight. We still need to stay more on the hawkish path. That would be the catalyst for dollar to hold this area, potentially start creating that weekly double bottom, and start to be trending back to the 104s and 105s, right? Maintaining more of this sequence of events of getting a 50% correction and continuation move, right? The only way dollar is going to potentially break this area and gold can start trending higher is we would need increased systemic risks. So for a dollar to start to have this higher time frame bearish leg move, I'm just going to point the arrow here. We would need continued bad US economic data. declining inflation reports, and further systemic banking risks in the US banking, further systemic US banking sector risks. Those are fundamental catalysts. And of course, neutral / dovish Fed stance, understanding market psychology, those are fundamental catalysts for us to be breaking below that price point at 101 and staying below 102, potentially starting to have a deeper, higher time frame bearish leg take place, trending down to the 98s and 96s, right? Now, what's very interesting is the bad US economic data so far hasn't been enough to break there. First Republic uncertainty with another US banking institution potentially going under wasn't enough to break there. And even the declining of last CPI and PPI reports were not enough to break there, right? So this week, we will need bad US PMI figures, dovish Fed stance, and of course, bad labor market data to have dollar breaking below that 101 handle. If we don't get that, and these would be the same type of confirms leading to gold buys. If we don't get that, we can easily start to see dollar domination come back into the scene, trending back to the 104s and 106s. Right? Hold above key higher time frame level, break above 102s, optimistic US data, hawkish Fed pressure, new global FUD, fear, uncertainty, and doubt, not directly impacting US markets or economy. So it's going to be a very, very important week as we're starting a new business month. And you can see these various asset classes, whether it's the dollar as a currency, whether it's gold as a commodity and precious metal, or even whether it's the US stock market, we're at very, very important price points of interest again. The same time we're starting out this new business month, and the same time we have very important pre-planned economic events in focus. US Fed rate decision, US PMI figures, US labor market data, and so forth. Right? So the same time dollar is sitting at this make or break level, roughly at 101 to 101.2. Gold is sitting at this make or break level, roughly sitting below the 2000s there, right? Any upside we've had been very short lived from even large fundamental catalysts coming into play. And even when you're looking at another asset class, such as US equities, when you're zooming out here, right? We are at the same price we've been at around April 2021, April 2022, and end of April 2023 right now. So we're at very key price points of interest that we're revisiting in terms of a liquidity zone. Both that was on the buy side and sell side. So you can see it's important. It's just a very important price you can deduct here. Right? That we can see whether it was during the last stimulus checks and pumping of the markets, we saw a lot of buy side liquidity accumulated here, or whether it was when the Fed started their dollar domination phase with the most aggressive rate hike cycle, we've seen sellers jump in hand here. right? And you can see we're at the exact same price we've been at every single April since 2021. Here, you can see the Monday 26th, end of April right here was here, 2021. Here in 2022, you can see end of April was pretty much sitting here. And here you can see April 2023 sitting at the very similar price point, right? So what would bring back bears into the market here and have large rejections would be so the only way we're going to see rejections on the stock market here from this very key price point is going to be if we have fundamental catalysts that lead to the markets pricing in more tightening of financial conditions by the Fed. That can be stronger US economic data that shows the economy is still robust enough to handle more rate hikes, bringing more demand into the US dollar. Higher inflation reports showing that the fight on inflation is not near complete, or very hawkish Fed meetings from their rate decisions, or important speeches from Jerome Powell and things of that nature. If we don't get that or any new global fear, uncertainty, and doubt, as well as the correlation of dollar trading above 102, VIX back above the 18 support level, then there's a higher probability stock market greed will extend. This is my main bias of potentially starting to see rejections in this area and to see a large correction and bears come into play. If we can't break above 34,500, we have dollar stabilize at that weekly level, and we start to see other major asset classes have a correction, like in the example of gold. This does look very high probability and a main bias scenario, but is completely data dependent on the Fed rate decision this week, US PMI figures, and US jobs market data. So what's really interesting though is the same time we're starting this new business month, the same time we have all these important figures in play, right? In terms of this economic data, Fed rate decision, you can see these various asset classes that are housed in the financial markets as a whole at very key price points. Gold at very important price points around the 2000s there at the higher time frame. Dollar as a currency at a very important price point, sitting around 101 and hovering below 102. US stock market in the example of Dow Jones at a very important price point in this liquidity zone identified around 34K to 34,500, on top of being at the exact same price points we've been at every single April since 2021. Right? So this is going to be a very important make or break week, in my opinion, and start to the month, which is going to give us some clear directional bias to play. for the next couple of days and weeks to come. And basically, if we do have optimistic US data, if we do have the Feds bringing the hawkish pressure and dollar domination coming back into the scene, then we will see a dollar rally start to take place that can last days or weeks, going back to the 104s and 105s. We will see stock market going back down to 32K. We will see gold starting to have a corrective bearish move down over the next days and weeks into the 1920s, and we will be jumping into that sentiment. Otherwise, if we don't get these confirms, stock market's going to be trending higher than 35K, dollar's going to be breaking below 101, and gold's going to be trading back above the 2010s, trending higher on the overall macro sentiment, and we will be adapting to that. Right? So we can even see that when we're coming and looking at the dollar pairs. We've been playing the upside on GBP USD and Euro USD very well, but keep in mind that important sell side liquidity zone is where we're digging into. Very hard for me to see any further upside on GBP USD or Euro USD if we cannot break these important liquidity zones, and especially if we have dollar stabilized back above 102 and the Fed's obviously bringing some hawkish pressure to the table with more optimistic US data. I'm not saying we have to go all the way down to 1.18, but seeing a larger corrective leg back down to 1.22 and 1.20 would not be out of the ordinary at all, right? You can see a similar type of case here on Euro USD, understanding the higher time frame, as we were looking to maybe even just sweep one more range up into 1.12. We've been very good continuing to adapt to these buys, Fed pivot prayer narrative, but if we can't break above this liquidity zone on the higher time frame here, we start to get those dollar domination confirms. Seeing an aggressive bearish leg down hundreds of pips would not be out of the ordinary at all. That's something we'd want to be playing for the next days and weeks to come. Right? So we're at very important price points across the board where the events that take place this week will more than likely be holding sentiment for the following days, weeks, even the entirety of the month to come. Obviously, you still have to keep an eye out for reactive events and things of that nature, but we can't ignore dollar still holding that weekly level, gold still rejecting that historical level, Euro USD and GBP USD coming to these major liquidity zones, US 30 on that very important price point of interest we're identifying and looking at there as well. So it's going to be a very interesting week. Now, just wanted to do that quick higher time frame review on gold, dollar pairs, dollar itself, and US equities as we're at key price points of interest, starting out the new business month with a lot of important data and pre-planned events in focus. In terms of GJ, we still are sticking to our bullish bias in this historical repetition we've seen take place since after the 2008 GFC financial crisis, where now that we're still having that macro rate differential of a dovish Bank of Japan and hawkish Bank of England, especially as Brexit has now been seeing solutions as well, it would not be out of the ordinary on the higher time frame to be trending to the price points that GJ was at before Brexit came into the play, right? So Bank of Japan still stuck to their loose monetary policy. Inflation is still relatively elevated in the UK, and Bank of England still needs to stick to their guns. We should be, in my opinion, printing some new highs here before having any type of pullback phase and still extending up to this manner, trending up to the 180s, 185s, and so forth. A lot of the fear, uncertainty, and doubt regarding COVID has been priced in. Buyers pooling in from better price points of interest, breaking out of that bearish structure. Very similar repetition and price movement to after the 2008 GFC. Very similar stretch we're seeing here. Potential to go back into these pre-Brexit price points higher time frame and macro is still going as per plan on GJ, still sticking to that bullish bias. So always good to do that bird's eye view, understanding the higher time frame, the macro fundamentals, and the events we have in focus. Now, we went through the weekly recap, we went through the higher time frame review. We just want to go through some intraday and trade ideas to start out this new week. Keep in mind, right? We're starting out the new business month, and we have a lot of holidays in terms of full day closures in China, Germany, France, UK, India, and other major regions around the world to start out the new month as well, with a lot of the more important economic data in the second half of the week. Rate decision is until midweek by the Feds. Labor market data for the US is until end of the week, right? So, in terms of market expectations, as we're still in these intraday ranges on gold, US dollar still having that indecision in terms of its individual movement, my expectations are very low in terms of volume and volatility, especially on gold, dollar pairs, and US equities. GJ could very well be extending the moves and sentiment from last week, as we still have Bank of Japan dovish monetary policy holding weight from obviously the Bank of Japan rate decision last week. But even on GJ, I wouldn't be surprised starting to slow down the volume and volatility and getting some pullback phases in secondary phases of market structure. So keep in mind, end of the business month, a lot of the events from previous week priced in, holidays across the board to start out this new week. So Mooj won't be doing a scalping session. He'll be probably doing a simulation back testing session or an educational webinar on his scalping concepts and strategies to make up for it. But there's not really a point doing a scalping session when you have so many of these bank holidays across the board. And in terms of economic events, to start out the week, there isn't really much through the Asian session or London session. We're just going to have some PMI figures that we will be focusing on during our New York analysis and scalping session. Now, because it's the start of the new business month, we already know volume and volatility is relatively low, and we just have these PMI figures in focus, which is from 9:45 and 10 a.m. Our scalping session will be starting around 9 a.m. Eastern. We'll be starting it around the new 4-hour candle instead of starting it at NY. So we can already see the setups with NY open, and then we can potentially play the larger intraday candle open, NYSE volume, and this economic data going into London session close hours. Now, we can see that they're expecting some slight rebounding on this data across the board. If that's the case, this can be the potentially start of dollar bouncing from that key weekly level and gold starting to break below the 1980s and 1970s, getting these optimistic rebounding PMI figures. Manufacturing PMI being above the 50 grade point and higher than prior, construction spending having that expected rebound, ISM manufacturing PMI having that expected rebound or higher, getting closer to the 50 grade point again, that can start to bring back US dollar strength in gold bears to start out this new week. It would be least preferred to get mixed economic data, leading to some more ranging and indecision. Something else to keep an eye out for is the Federal Reserve will release its internal review and supervision as well as regulation of the Silicon Valley Bank collapse, which will be led by Fed Vice Chair Michael Barr. It doesn't really say a time for that as well. It just says May 1st. And obviously, we're not going to be having any other Fed speakers or speeches up until the FOMC in focus this week. Now, in terms of intraday trade ideas, I would still be looking to take similar trade ideas stated and continuing from our last market update webinar, but potentially seeing more exhaustion by gold buyers, as we can see something very interesting. Dollar still holding that very key weekly level. Yes, gold has been holding this level, but when you're looking at the candle bodies, the buy bounces have been getting significantly smaller and smaller here, right? We have been seeing the buyer volume decrease from the bounces we've been having in this area. The same time, dollar strength is starting to have the same time dollar strength is starting to hold some more weight. As you can see, last week we had a very weak bearish candle close, potentially starting to show the first signs of a larger weekly double bottom here, where if especially we start to break the 1980s, and especially if we get that optimistic US data, we can see dollar start to have its bounce and gold potentially start to enter its corrective leg. It's very difficult for me to see any further gold buys unless we're trading above 1997 and 2005. And even then, I'd be very hesitant with the reactions at 2010. So if we can see dollar continue more bullish, especially start to trade above 102, gold be breaking below these price points, we can potentially start to see some sells take place, which I'd at least expect to be revisiting the 1960s before starting to get some pullback. Stay adaptive to EOM. Overall ranging. Otherwise, the only way I can see any further gold buys that I would adapt to would really be above 1997 at this point. On GBPJPY, I still want to continue the bullish sentiment and bias. One thing we have to look out for as we're starting out this new month is we can validate based on key price points of interest, where if we don't break these high points, we can potentially see new monthly setups and some aggressive pullback waves that can take place, where that pullback wave could easily be going, doesn't have to come all the way and cancel out the move, but could easily be going to revisit 170s, 169.5 area before continuing more bullish. So we are potentially approaching a very important price point around this 172 handle. If we break above there, I can easily see buyers just extending further, continuing the Japanese yen weakness and dovish Bank of Japan sentiment. If we don't break, I could see a larger pullback phase take place. Now, when I'm looking at intraday price points of interest, one, that price sensitivity area to the left is also where we had this intraday accumulation here. So roughly this 169, 169.5 area for pullbacks. But to see that and retest that key price point of interest, we would need to be breaking below 171. Breaking below 171, I can easily see a deeper aggressive pullback phase going to that accumulation zone and key price point of interest we're looking at to the left before buyers come into the market, setting up the new monthly order flow and trending higher. This would also be roughly a 50% correction of this larger impulsive move, be revisiting this last area of interest where during this larger trend, we had an accumulation of order flow here, as well as retesting those key price points to the left. Otherwise, if we just hold these areas and break above key level as well as that price point to the left, we're just going to see buyers extending further. Okay. On GBP USD, we can still retest these better sell zones of interest we were talking about. If we still hold above these previous highs, I would still see buyers extending further before starting to look for sells around 1.263-265 liquidity zone. Starting to look for reversals there based on higher time frame key price points of interest. Otherwise, I'd only be jumping in the sells if this buy area is invalidated. We cancel out this upside move and have dollar trending back to 102, hold below the previous highs, and start to get breaks below these price points at 251 and 246. On Euro USD, we can see a bit more exhaustion at these previous highs in liquidity zone here, where it's difficult for me to see any further buys unless we have dollar weakness and breaks above 1.04, where I'd still be looking for those higher risk, higher reward sells we were talking about. Otherwise, if we start to break below 1.0985 and 1.096, with dollar domination confirms, we can start to see these potential reversals start to take place. Of course, it's going to be data dependent, but we're at very key price points of interest across the board when we did our higher time frame review. Now, USD CAD did our expected pullback, but we have to understand that even though we didn't get the best entry confirms, we were expecting more bulls on USD CAD if dollar didn't break that weekly level and USD CAD didn't break this key demand zone that's been held ever since the dollar domination phase and this bullish market structure formation here. Very nice cancellation of this downside move, but we could easily still see these corrective legs before continuing higher. Understanding that, if you want to play these deeper legs down and pullbacks, which is very common on USD CAD, you can if we break below these price points. But I would start to be looking for buys at 234 and 348. Otherwise, jumping back into buys above 365. US 30 on the intraday, we're still respecting bullish structure. VIX is still bearish. And we could easily be digging into that liquidity zone that we were talking about. I would still see these buys starting to look for sells at that price point of interest we're talking about. Right? Otherwise, I could only be jumping back into sells if we're really at this point breaking back below 33.5 and 33.250. Okay? So make sure if you're a new member, you're probably not going to understand much that's going on through these through these updated market analysis webinars, higher time frame review, and when we're going over fundamentals. So make sure you go through all of the educational webinars in Capital Hungry Process. Other than that, make sure you go through the weekly flow, re-watch this webinar if you need to, take your notes for information retention. And yeah, that was just the weekly recap, a higher time frame review, and just some market analysis and trade ideas to start out this new week. Keep in mind the events in focus and current conditions in play.